If you are a new investor looking to invest in the stock market, you've probably wondered what you need to know before you begin. In this video, we dive into an exciting topic, what you need to know as a beginner investor. Let's get straight into the video. So what are stocks and how do they work? We can define a stock as a unit of ownership. This means when you buy the stock of a company, you now own a percentage of that company. Companies typically sell stocks to investors to raise capital for various needs. This could be scaling their operations, reducing their debt, or meeting other financial needs. Now that we know what a stock is, we can now move to the stock market. The stock market is the market that deals with the buying and selling of stocks. In Kenya, this market is known as the Nairobi Securities Exchange. There are 63 companies whose stocks are available on the Nairobi Securities Exchange. These companies include Safaricom, ABSA, Cooperative Bank, Williamson Tea, among others. In Kenya, on the Nairobi Securities Exchange, the minimum quantity of stocks purchasable was previously set at 100, but now investors have the flexibility to buy as little as a single share. There are 5 main players in the stock market. The first one, as we have already mentioned, is the Nairobi Securities Exchange. The second is the CDSC, which is a depository account similar to a bank account, but instead of money, this is where your stocks are stored. Third is the stockbroker. This is the means by which you gain access to the Nairobi Securities Exchange. At AIB-AXYS Africa, we provide the platform for you to buy and sell stocks on the Securities Exchange. Next is the Capital Markets Authority. The Capital Markets Authority serves as the regulatory authority over the market. They ensure that all players in the market operate within the stipulated guidelines. Last but definitely not least is the investor, that is you and I, who invest in the stock markets. Next, let's look at how investors make money from the stock markets. First is through dividends. A dividend is a payment given to investors who hold stocks of companies on the NSE. Dividends are a way to reward stockholders for owning the stock. Usually, these payments come from the company's profits, but some companies may still choose to pay dividends even if the company has not made any profits. Each year, a company's board of directors decide whether to distribute dividends. Some companies have the tradition of distributing dividends regularly, known as dividend stocks. For example, this year, Standard Chartered Bank will pay a dividend of 23 shillings to its investors. This means that if you own 1,000 stocks with them, you will earn 23,000 shillings at the dividend payment date, which is on 30th May 2024. The second is through capital gain. This is called buying low and selling high. When an investor sells a stock for more than he or she initially paid for it, we call this a capital gain. The opposite of this is called a capital loss. For example, in January 2024, the Equity Bank stock was trading at 33 shillings per stock. Currently, the Equity Bank stock is trading at 47 shillings. This means that investors have already made a return of 42% on their investment. Now that you have understood how the stock market works and how to make money on the stock market, how do you invest? First is to set clear goals. As an investor, you need to understand your personal finances. Understand how much money you're willing to invest. Remember that every investment carries risk, and if you invest more than you can afford to lose, then you will have made a bad financial decision. Define your investment goals. As an investor, you need to understand whether you're looking for short-term gains or long-term growth. When you understand this, you're able to make an informed decision when selecting your stocks. Before you invest, think about how much risk you're comfortable taking. Understand that stock prices can go up and down. Therefore, don't invest blindly. As an investor, research the companies that you're interested in. Research the company's financial health, growth potential, and competitive position in the market. For instance, examine the company's profits over the past 5 to 10 years. If a company isn't profitable, it is less likely to pay dividends. For growth potential, you can check whether a company is expanding into other regions, whether they have new products, and how these new ventures are doing. To assess a company's competitive position, you can check whether they are the top player within their industry or is there a better competitor. When picking a few companies to invest in, diversification is key. Spread your investments across different sectors and industries to reduce risk. Diversification protects you from the volatility of individual stocks. For example, if your agricultural stocks take a hit because of drought, your manufacturing stocks could still be doing well due to a construction boom. Because stock prices fluctuate, when you diversify, you can still be making money overall, even if one stock is not doing well. Now that you have picked your 3 or 4 stocks to invest in, stay informed. Stay updated on market trends, news, and economic issues that may affect the stocks that you have purchased. This knowledge will help you make well-informed decisions. At AIB-AXYS Africa, we provide timely information to our clients to keep you going as you invest. Now, if you haven't already, this is your chance to open a trading account and put the information in this video into practice. You can do this by downloading the AIB DigiTrader app on any Play Store and click on Open New Trading Account to start your journey in investing in stocks. And there you have it. If you found this video helpful, please consider subscribing to our YouTube channel for this and more informative content. Thanks for watching. See you in the next video.